Good morning. So the huge super changes have got royal assent yesterday. So they're the incredibly large changes, the biggest changes certainly since 2007, so in about 10 years. And those 2007 changes, they were called the simpler super changes. These ones instead are called the fair and sustainable super changes. So there's been a lot of talk of, what's fair and what's sustainable for revenue. And what's fair is different for different people. So moving forward, this is the summary of the main changes. And so I'll just go through those. One of them's lowering that non-concessional contribution cap from that $180,000 per annum to $100,000 per annum. That one commences, like most of these changes, on 1 July next year. Now, members from 1 July 2017 who have a total super balance in all of their super accounts of greater than $1.6 million won't be able to put any of those non-concessional contributions in. So that's something to watch out for. And of course, well, that bring forward rule will still apply, but it'll be on that new limit, that $100,000 limit. And we can still, clients can still contribute that $180,000 in before 30 June or 540 under the bring forward rule. Or if they even invoke that bring forward rule prior to 30 June, they don't have to worry about that $1.6 million test. The concessional contribution cap has been reduced from $35,000 or $30,000 depending on age to $25,000. That's for all individuals. And the non-concessional contribution cap is going to be 4 times the concessional contribution cap. So there is a mechanism for that to increase in round numbers in accordance with inflation. The Div 293 threshold, that's been lowered from $300,000 to $250,000 from 1 July 2017. So if you or your clients have been lucky enough to receive one of those assessments, unlucky enough, sorry, it's quite a complicated calculation and quite a complicated tax that no one really likes receiving. And certainly, clients and members will be a bit dirty if they get one of those and didn't know about it beforehand. So lowering that threshold, I guess we'll see more of that. Now, this is the really big change, and I'll spend most of today walking through these changes as to the $1.6 million transfer balance cap. And so there's quite a lot to that, and I'll go through that in a lot of detail in the coming slides. Another change is we'll transition to retirement income streams, no longer be tax-free. So the earnings in those will still be taxed at that 15% tax rate. And similarly, we can't pay lump sums under those TRISs anymore. So effectively what that means is for those TRISs, we've got a $25,000 contribution cap, and we're not getting, the tax-free exemption on those earnings inside those TRISs. So really, they'll be a lot less attractive to members, other than those members who are using them, for their purpose that they were initially legislated for, and that is where they want to transition to retirement, but and reduce their work hours, but they need some supplemental income, so they can still live their lifestyle. So they'll be the only people using TRISs moving forward. The good news from reducing the concessional contributions, because that's affecting a lot of people who really wanted to prime their super closer to retirement, is that there'll be those catch-up concessional contributions for those with balances under $500,000. And so that one only kicks in on 1 July 2018 is the first year you can look back, to do these catch-ups. So it's really, we're not going to see these things utilised until, the 2020s, really, looking back on those. And it might even be the case you have a big capital gain in a trust, and perhaps you could look at mum super account and that type of thing to see if they can play catch up on some of those concessional contributions. Of course, though, the work test, it was mooted in the budget, or it was one of the measures, was that the work test would be abolished as part of these methods, as part of the changes. However, the work test is still around. That was part of the bartering because we got rid of that ugly $500,000 lifetime non-concessional cap. And so now we've still got that work test that we've got to comply with. So that's still part of the rules. Good news though is we don't have that 10% rule for people who earn greater than 10% of their total income from employment sources. So now anyone can make concessional contributions. So that means employees can in June really have a look and top up their concessional contributions so they get to that $25,000 level. So that's good news and probably means that there'll be a lot less focus on salary sacrifice arrangements moving forward. That low income tax offset, the income threshold to have access to that has increased. The anti-detriment provisions, so for those who die after 1 July 2017, for those who die after then, they'll no longer be able to have that anti-detriment payment anymore. There is a transitional method, and so this is quite good for the larger funds. So if someone, say, dies in the next 6 months or before 30 June 2017, those funds have actually got until 30 June 2019 to make that anti-detriment payment. So that gives them a bit of time to go through all their bureaucracy, handle any disputes and that type of thing. So that's a good measure. The objective to the superannuation purpose being enshrined in legislation, that's one change that hasn't got through yet. So that's been kicked back to a Senate committee due to report back in February or so. I'll still talk about that soon. And we've got those tax offset for spouse contributions. So just starting with this objective to the superannuation system. So this is a separate act. It isn't like the sole purpose test. It's not part of the SIS regulations. What it is, it's more a guide for legislators, for parliamentarians. So if a member introduces a bill, if that bill touches upon superannuation or has a possible consequence for superannuation, together with that bill, it's got to be accompanied by a statement of compatibility, showing what the how that legislation or draft legislation complies with the primary purpose and the subsidiary purposes of this superannuation. And so the primary purpose is to provide income or substitute or supplement the age pension. So providing income to substitute or supplement the age pension. And then there's some subsidiary objectives, which are referred to in the explanatory memorandum, and they're going to, they say, introduce those as regulations. And they don't make too much sense to me. They're smoothing consumption, managing risks in retirement, investing in the best interests of members, and being simple and effective, and to provide safeguards. So the irony here is, I think, is if this law had come in and we needed to do a statement of compatibility with these fair and sustainable super changes, certainly the simple and efficient grounds, I don't think we would have passed that test. And bear in mind too, well, if it does pass, this is just legislation. So, one, the Parliament can change that legislation and change that purpose of super at any time. It's not constitutionally protected under this Act. Secondly, there's that obligation to have this statement of compatibility, but what if it doesn't comply? Does it mean that the legislation isn't allowed to be passed? Not necessarily. And also, it's funny, the explanatory memorandum to all of these super changes was about 380 pages, so quite a bit of reading. And in all these different bills, there was about 4 bills that were introduced. They already had a statement of compatibility that went on for a couple of pages about how these laws didn't affect any human rights of any person in Australia's human right international treaty obligations. So I really see, this legislation being a bit of a bureaucratic procedure and just creating a bit more paperwork. So the Bring Forward Cap, I guess before I get on to after 2017, what about if we trigger the Bring Forward non-concessional contribution mechanism prior to 30 June 2017? So if we'd triggered it last financial year, it would have been 180,000 would have been the cap for that year, $180,000 for this year, and then $100,000 for next year. So they're those total caps that are Bring Forward too. Similarly, if you commence it this year, it's 180,000 for this year, and then 100,000 for the next financial year, and 100,000 for the financial year after that, if that makes sense. Now, I guess there'll be a bit of a rush on of people trying to really maximise that $540,000 contribution under the Bring Forward rule prior to 30 June. Firstly, because they don't have to check if they got a $1.6 million balance. You know, anyone can actually trigger that, providing they haven't already exhausted their bring forward ability. But let's say if they don't have enough money to do the whole 540 and they've got over 1.6 million in their super accounts already, what they might do is, you know, put $180,001 into super, because then no questions asked, they still get to put in that, you know, $99,999, you know, plus that other $100,000 in the coming 2 years. But after 1 July 2017, well, we've got to have a look back on, you look back on the prior 30 June. So what was your total super balance between all your accounts and your rollover benefits, etc.? What's your total super balance of the prior 30 June? If it's more than $1.6 million, well, you can't put anything in under the non-concessional contribution cap. If it's less than that $1.6 million, but more than $1.5 million, well, you can put in $100,000. So, you know, it's not part thereof. If you're just $1 short of $1.6 million, you can still put in the whole $100,000. Then similarly, if you're between that 1.4 and 1.5 million, you can put in that $200,000 and you've got over 2 years to do that. And then if it's less than the $1.4 million, you know, you can put the whole $300,000 in and you've got that bring forward period of 3 years. All right. So the 1.6 million transfer balance cap. So there's a few items to deal with here. So let me start, I guess. The 1.6 million transfer balance cap, that's the general concept. So what that cap is, that it applies to everyone. But in the legislation and the explanatory memorandum, they're introducing this concept of an individual's transfer balance account. It's not a real life account that we set up with NAB. It's a notional account, which says where we're up to with our $1.6 million transfer balance cap. And then, you know, there's debits where it gets deducted, and there's credits where it gets added to. This cap's indexed, and it is indexed, so it'll only go up in $100,000 increments to make it easy for people like me to give their nice little case studies. But when we're looking at what percentage, what's been used of the cap and what an individual has got left under the cap, when we're proportioning that moving forward, we're looking at a percentage focus and not a dollar focus. And similarly there, when you're looking at that percentage, we're looking at, it gets rounded down to the nearest whole number of a percentage. So, you know, when we're putting money into these accounts, we might want to be cognizant of that. And you really want it to be, you know, 25.01%, not 24.99%, because you're losing out, your client's losing out, or the member's losing out on their ability to contribute, you know, some dollars into super if it's rounded down a significant amount. So we've got the concepts of this individual account, what's a credit to that account, so where it goes up, and what's a debit where it goes down. I'll talk about that in more detail. What happens with reversionary pensions, and then there's a whole lot of special rules with child pensions. They're incredibly complicated. There's changes to how rollover of death benefits are treated. One item that accountants, financial planners might really look to focus on moving forward is this ability to reset the cost base and make that election. I'll talk about that some more soon. Then if we stuff it up, if we've got too much in that retirement savings account and we've exceeded that transfer balance cap, there's deemed earnings of those. I'll talk about that more. And then there's some tax that applies on those deemed earnings. So I'll go through these in a bit more detail. So your credits to your account. So come 30 June 2017, what's actually in, you know, these tax-free pension accounts? So, you know, that's a credit, whatever the value of that superannuation interest was on 1 July 2017. Start a new pension into that, you know, 1 July 2017. So they've got this concept of, yeah, that your retirement savings phase is that tax-free phase. Also, if you receive a reversionary pension from another member, yeah, that's a credit to that account. So those credits are reasonably straightforward. The debits. So your debits to that account are commutations, and I'll go into what they involve in the next slide. So that's where if you start off with, say, $1 million in your tax-free account or your retirement savings account, as they call it, and then that's 500,000 commuted out. So then that balance goes down. So you can top that back up. Other items, there's some specific items there. So if the account was diminished due to fraud, you've got to actually get an individual who's convicted for the fraud, and then that's allowed to be a debit into that account. Similarly, family law payment splits, we've got to give a certain form to the ATO notifying them of this split and of that debit. Non-commutable excess transfer balances. So there's a deemed debit for some of those lifetime pensions, market-linked pensions, defined benefits that we can't commute. Again, if we had a clawback, so if the trustee in bankruptcy successfully clawed back some contributions to super that had been put into that retirement savings account, that's a debit, so it goes down. Structured settlements, when you hear of those, they're those personal injury settlements. So it's got to be where someone's been permanently incapacitated and not likely to work again. So the entire amount of that is a debit. So that applies to people who have got those amounts in super already. So the entire amount of that isn't counted towards a 1.6 million cap. So someone who had one of those settlements can, one, put that money into super without it being subject to the non-concessional contribution caps. There's an unlimited cap for those personal injuries. And then secondly, they've still got another 1.6 million on top of that they can have in that transfer balance cap, that personal account. So when we're looking at commutation debits, I guess what people will want to be focusing on is if there's payments under this retirement savings account, if there's pension payments which exceed the minimum. So let's say if we had a member whose minimum pension payment for a year was $40,000, but they wanted to go on a holiday or do some house renovations or whatever, and so they wanted to take out $100,000 or took out $100,000 that year. So when it's a pension payment, they're not a debit. So when it's a minimum pension payment, or even if it's a normal pension payment. So let's say if you had a $1.6 million in this account, and then the client paid the whole lot out, and all of those payments were treated as a pension payments, well, then they've exhausted that retirement savings account and they can't put anything more in it. What they'd be wise to do, though, is to actually anything above that minimum to treat it as a partial commutation. So you do that election to treat the payment to the member as a lump sum. Now, that election's got to be made before the payment. So, whether we work on resolutions at the start of the year and, we load the client with the right forms, it's, technically it's too late to be doing it a year down the track when we're doing those financials. But the name of the game there will be making sure, really we only do those pension payments up to the minimum, and anything after that, we do that election to treat it as a lump sum, because lump sums are debits, whereas minimum pension payments aren't. They're lost forever. So similarly, another commutation debit is if we roll that back to accumulation. So let's say if you started with a amount in this retirement savings account, then the client wanted to work again, and they rolled it back to accumulation. So then that's a debit. Member lump sum, so that's fairly straightforward. I just talked about that. We've got this ability now for negative account balances under that personal transfer balance cap account. So in that example, let's say we started in 1 July 2017 with $1.6 million. Then over the next year, when the next 1 July 2018, after we'd made our minimum pension payments, that account was actually worth $1.7 million due to some investment returns and earnings. Then we decided to roll that back to accumulation. So we've got a $1.6 million cap. We've exhausted that whole cap, but we've got a $1.7 million debit. So then we're negative $100,000 in our account. So down the track, when we want to kick money back into that personal transfer balance cap account, we can kick the whole 1.7 million in. So that's how those negative account balances work. Another one that's a debit is if your pension ceases. So, for example, you didn't meet that minimum pension payment and the pension ceases on those terms explained in TR 2013/5. So let's have a look at how this transfer balance cap is indexed over time, on that personal basis. And as you remember, I said before, it's done on that percentage basis rather than on that dollar basis. So this is an example from the explanatory memorandum. I've just put it in a graph form to make it a bit easier to follow. So in this example, on 1 October 2017, Nina starts a pension. Her cap, like everyone else at that point, is $1.6 million, the transfer balance cap. However, she starts that pension with $1.2 million of it. So doing the sums, that's 25% of that cap is unused at that point. Now, on 1 January 2018, she commutes $400,000. So her personal balance goes from $1.2 million to $800,000. However, when we're looking at the proportion of the cap she hasn't used for when we're indexing that in the future, we don't look at what it is at the time of the indexation. We look at what the maximum was that she's ever used. So we're still stuck with that 25% amount. So in July 2020, that cap's indexed by $100,000. And that's how they'll go up, by $100,000 increments. Now, Nina's personal cap then, her total personal cap increases from $1.6 million to $1.625. And that is 25% of that $100,000 increase. Again, a couple of years later, that increases by another, the general cap increases by another $100,000 to $1.8 million. So then Nina's personal cap is 25% of, that 200,000 increase. So it's that 1.65 million. So in 2022, when she looks to really use up the entire amount of her cap, she's got a $1.65 million cap. She's got $800,000 presently credited in her personal account. So she's got that ability to kick in another up to $850,000. So once she does that, once you've maxed out the total amount of that personal cap, whether it's 1.6 million in July 2017 or that increased amount with indexation down the track, you can't you forget about it from there on. You forget about indexation. So you can't, once you've used that whole cap, you can't go and say, oh, I'm going to access some indexation. You've used it all up. Now, I guess when I was talking about what debits and credits were before, importantly, what I didn't say is quite relevant. And so for those debits, what isn't a debit is investment drawdown. So if your earnings, you have a GFC kind of situation, and so you had $1.6 million in the account, and now it's only $700,000 because the share market's crashed. That's not an event that affects what your cap is, so you can't get any more money in. What they said in the explanatory memorandum is, look, like when the GFC happened and we reduced the minimum pension payments from 4% to 2%, we will seek professional advice at the time and then see if it's appropriate to put any measures in place to deal with any GFC type of arrangement, but it's not appropriate to actually legislate for that now. Similarly, it's not considered a credit if your investment goes up. So, if you make some good investment choices, there's potential that one member could have, $3-4 million in that retirement savings account because it's just, gone up and had those good capital gains. There might even be the potential to, have limited recourse borrowing arrangements inside of that account. So, child pensions. Bear with me here. This one's a bit involved. So, child pensions, obviously, it's when a parent has died. So, still the normal rules is the child's got to be either under 18 or under 25 and still dependent on the parents. Now, if the parent dies before the having reached that retirement phase interest, so before they've actually got any money into this transfer balance cap account, their personal account, because they haven't retired yet, they haven't set up a tax-free pension yet. If they die before that, the child gets up to the whole $1.6 million. However, it's done on a percentage basis. So if there were several beneficiaries, let's say there were 3 children who were all beneficiaries, they get 1/3 of that parent's possible cap. They don't get $1.6 million each. On the upside though, you get 1 cap per parent. And so that is, let's say if both parents died at the same time or died after each other, there's $1.6 million for each parent to be split between the children. Again, it's up to $1.6 million if the pension commenced before 1 July 2017, to be shared. Now, if the relevant parent had started that retirement phase interest, the cap that's inherited by the relevant children and split between the relevant children is what the deceased member's cap was. And so, you don't create a new $1.6 million cap, you inherit their cap. And let's say if the parent had started a retirement savings account and then they'd exhausted that whole cap, and so they were living off accumulation. Well, that's too bad. They've got zero left in their cap. They've exhausted that whole personal account, so the children can't inherit anything there. They can only be paid a lump sum, or a lump sum be paid via the estate. The good news for kids is that if they receive, say, an $800,000 cap from their parents, and they get paid a pension from their parents, and they don't really see any of that because it's all spent on their school fees before they're 18. They don't then get that debited off their, allocated to their own cap. Their cap starts afresh. So, that's the good news. So, reversionary pensions. So the good news is, so let's say if there was husband and wife and then the husband died, the wife then has a look, and her total superannuation inside this retirement savings account can only be $1.6 million. That includes any amount from a reversionary pension. So you don't get two bites of the cherry. You don't get your own account, and then if you're a reversionary beneficiary, your spouse's account. However, the good news is that there's a 12-month grace period. So we can still be receiving two pensions under a reversionary pension for up to 12 months and then decide, okay, we can choose. Do we want to take the spouse's reversionary pension, or do we want to pay that out as a lump sum and just keep, the pension, the amount that we've got already in our retirement savings account? So, got ability to be receiving two tax-free accounts for a little while there, and gives us a little time to kind of, get the affairs in order. One concept, and this is just for your ordinary pensions and commencing pensions too, is to actually be able to receive a death benefit as an income stream for that beneficiary. The spouse there has to actually be in that retirement phase. So, for example, quite often if we're setting up a limited recourse borrowing arrangement, and so there's a lumpy asset such as business premises inside the fund, part of that is the financial advice I'd receive would be, well, what do they do if one of the members dies? And presently, even if they're in their 40s, if one of those members dies, what they can do is, well, the spouse will be, receive a pension from that member. There might be some tax consequences. They have to pay a little bit of tax on that pension, but then they can roll that back into accumulation after that 6-month period. It becomes that surviving spouse's account, and we haven't had to pay out, the super benefits of that deceased spouse. And so that's not allowed anymore, because in your 40s, you're not eligible to actually receive a pension. So it's going to be forced in those situations that the deceased member's pension, if you're not going to pay it to a child, will actually have to be paid out of the superannuation environment. So, some challenging estate planning and planning problems arise from that. Just a question from Catherine here, back to your children's pensions. If parents die and they have $5 million in their super fund, does the child only get $1.6 million? If yes, what happens to the $3.5 million left over, assuming there are no other kids? So I guess there's not quite enough information in that question. Let's say if the parents died and they had $5 million inside that their retirement savings account. By parents, okay, we'll say there was two parents. They had their $1.6 million account each, but that amount's actually, that caps their personal account's gone up, and so they had the whole $5 million actually in that retirement phase. There wasn't any in accumulation. If that's the case, well, the parents get inherit the cap that both of their respective parents had. If there's only one child, they inherit the whole cap. If there's more children, well, it's a percentage basis that they'd inherit there. If the parents had a proportion in that retirement savings and a account, so their transfer balance cap account, and they had a proportion in accumulation, the accumulation has to get sent out of the super environment as a lump sum, and you can only be dealing with starting those child pensions with respect to the amount that was in the parents' retirement savings account. So yeah, there's a lot of implications. There's a lot of examples in the explanatory memorandum, and there'll be a lot of working through. No doubt there'll be lots of interpretive decisions and ATO guidance to help us through there. I guess from all of this, I guess it's just too much to be planning to the last detail of exactly how these children pensions would work and what split up you'd get. So I'm really saying to a lot of people, for these nuclear family type of situations where we don't have blended families, it's husband and wife, you've got the kids from their only marriage, and so the risk of family provision claims quite low, and estate planning is relatively straightforward. Perhaps not having binding nominations and not having reversionary pensions there's a lot to be said for that. Perhaps that's a good way moving forward, because then you can get all your good tax advice and professional advice when someone dies and have a look exactly what their account looks like at the time and what their options are, rather than tying them into a course that could potentially be a bad tax result for them. If you want to discuss that further, happy to chat afterwards, Catherine. I've got to move on. We're limited in time. So this is a big one. So your rollover of death benefits. I've already said that for those spouse death benefits, the beneficiary must be eligible already to receive that income stream. So we can't start it for people who are in their 40s and haven't retired. The interesting thing here is what presently, until 30 June this financial year, if we've got husband and wife and husband dies, what happens there is we can commute that pension over to the wife. So the wife starts being the beneficiary, even if they're not a reversionary beneficiary. They end up being the beneficiary of that deceased husband's pension. Then, after a period of time, I think 6 months, they can roll that back, and that can mix with the surviving spouse's own superannuation benefits. So, that can get brought back into the super environment. So it's no longer a death benefit. It's now the surviving spouse's superannuation benefit, and that's 307-5. Now, that's no longer the case. Now, if a spouse dies, there's a death benefit pension, and so that can get commuted, subject to how we deal with those caps, can get commuted to the surviving spouse. However, it's always going to be that death benefit pension. It's always going to be that husband's death benefit pension. So if we do put that money into the retirement savings account, we can't really take out husband's pension and roll that back to wife's accumulation account, because it's not allowed. We can't mix those interests anymore. It's either that gets paid as a pension to the surviving spouse, or it gets paid out as a lump sum outside of the super environment to the surviving spouse. So we're really seeing here, this legislation is designed to get money out of the super system on death. So, they say they don't want it to be an estate planning tool anymore. So I think it doesn't mean we don't do estate planning anymore. I think we've got to be a lot more careful and a lot more nuanced when we're doing our estate planning moving forward. So the tax excess transferred balance earnings. So if you have looked and if you remember for your excess non-concessional contributions, in the last couple of years we've had this mechanism where if we accidentally make an excess non-concessional contribution, when we realise we can take that money back out, but then we've got to pay some tax on the deemed earnings of that, not the actual earnings. And the deemed earnings are based on that general interest charge rate, which is presently about 9%. It's a benchmark rate plus 7%. I think 90-day bank bill overdraft or something plus 7%. So then you pay your tax on that. So the same idea happens here, is you have a look, okay, we allocated too much to, we left too much inside this retirement savings account. We had 1.8 million instead of 1.6 million. So on that excess, there's a deemed earnings rate of 9%, and that compounds daily. So we have a look here, and then the tax on that, when it's found out about, is firstly 15%. So that makes sense. That's what they would have paid if it was in accumulation. Then to try to avoid people, trying to beat the earnings rate and be smart about it, you do it a second time. You do it next year, the year after, sorry. Well, then it's 30% is what the tax rate is on those deemed 9% earnings. Now, there is a grace period. So if we stuff it up by less than $100,000 and we fix that account by the end of December 2017, well, there won't be any excess earnings issue we need there. Now, when you do find out you have an excess earnings, you can have an election to commute, and that can be served on the trustee of the super fund, or you can elect, to commute out of specified pension accounts. And then the ATO's got a commutation authority, and they've got those default commutations. So a super fund's got to comply with the commutation authority within 60 days. And I think the consequence of not complying with it can be that the pension is deemed to have ceased too. Now, there's some special rules for capped defined benefit income streams. Now, while I'm on this point, really, we're advising self-managed super funds. And forgetting about the other superannuation interests that clients might have, like just pretending for a second that clients only got their one superannuation interest, which is in their self-managed super fund. Now, there should be no reason why us as advisors, the super fund administrators and the accountants managing those funds, there should be no reason why we actually have an excess issue. And the reason there is because it's really an exercise on getting those resolutions correct. So we resolved to take an asset out of that retirement savings account and put it into accumulation. Or even easier, on the proportionate method, the resolution's more along the lines of, as from 1 July 2017 or 30 June 2017, $1.6 million is of proportion of the fund is allocated to the retirement savings account, and the balance is in accumulation. And we'll use that proportionate method. So we've got to get that actuarial certificate moving forward. So, we don't need exact numbers. If we don't have those exact valuations, it's been achieved through your resolutions. And, then you sort out the exact figures when you know them down the track. So we might get in trouble as advisors if we miss this and we stuff this up, because, it is quite solvable in a self-managed super fund perspective to get this right. But certainly, it's time to start thinking about it over the Christmas break and, in January, rather than down the track. I'd be suggesting to accountants, financial planners, super fund administrators, perhaps, do a bit of a sum. Who's approaching that $1.6 million members balance amount and, is in that retirement phase? Anyone approaching that, kind of, get that list and then get an action plan together, to what are you going to do, and, when are you going to see these people, and have a bit of a plan of action. And there's a lot of work involved, so I'm sure people expect to have to pay for this kind of review. All right, so these slides, sorry, I thought I'd be able to do them as pop-ups, but I haven't been able to, so I'll try walking you through this. Now, this is another one of these items that we've really got to look at before 30 June, and that is we've got this ability now for this limited time before 30 June 2017, when we're rearranging clients' affairs to make sure that they've got $1.6 million in the tax-free retirement phase. We've got this ability to rejig the cost base element, and the rationale there is, well, if there was, say, a super fund, and that super fund had $6 million, and it was all in that pension phase, so that tax-free phase. I guess what we could do is, before 30 June, we could go and sell all of those assets, and we wouldn't pay any capital gains tax, regardless of what the cost base of those assets were. However, most people want to keep their assets, so they don't want to do that. What we've got this ability to do, we've got this ability to create a deemed capital gains tax event, even though there isn't really a sale. And what they've done there is they've said, well, we're going to deem this to be an A1 event. So when we take an asset out of the, that pension phase, that tax-free phase, and we're putting it back into the accumulation phase, we're going to deem that to be a sale and a repurchase. And we're going to say that's an A1 event. Doesn't look anything like an A1 event to me, but that's the way they've drafted the legislation. Would have made more sense for them to make a, I don't know what event, an L event or something in respect to this. And so what you do there is, if you're going to take advantage of that, is you've got to make the choice. And it's not one of those choices like some of these superannuation choices where you just file it in your bottom drawer for someone to look at down the track. It's got to be on the approved form. We don't know what that is yet. Maybe that will be, the form in the tax return, but it's got to be lodged and it's got to be made on or before the date the income tax return's due. So be careful with late tax returns, I guess. Once you make that election, it's irrevocable. So, if you thought, oh, this is going to go up in value a lot, I want to refresh the cost base, and it didn't, the assets didn't perform how you wanted, you can't reverse that election. So we've got here your segregated approach. And so under that, with your segregated approach, we have an asset that's entirely segregated. We transfer that from a pension account to accumulation account, and so then we can make that election and we can inherit today's cost base. So we get that, get a valuation done, and so that's the cost base of that's inherited. So when we sell it down the track, we don't pay capital gains tax on what the original purchase price was, but what the purchase price was on your 30 June 2017. Alternatively, we might not want to make that election, and then it's just that original cost base. So if you don't make that election, it's just whatever that original cost base was. We're not limited. So, if we have to transfer an asset out and of the retirement savings account and it's more than what we need to transfer, you get that cost base reset for the entire value of the asset, not just part of the value of that asset. Now, for the proportionate approach, so there's some funds that might have assets in proportionate. So there's a proportion, if they sold that asset now, that would be capital gains tax free, and a proportion that would be taxable. Now, under that event, if there was a deemed capital gains tax event, well, then there'd be a proportion of that capital gains tax that would need to be paid now. In that scenario, we can make that election to reset that cost base. Then we can make a further election. We can pay that capital gains tax now, or take that straight away now, or we can defer that until there's a real sale. So we don't actually have to account for that tax until we're actually getting money for it and down the track. There's even the ability too. We could actually make this election now to utilise, say, a capital loss that an asset has, because we've got some capital gains we want to offset that against. So there is some ability to play with that. However, what we've got to watch too is there's this pre-commencement period concept. So that pre-commencement period is on 9 November 2016. So what they're wanting to avoid there is they're essentially integrity measures. So what we can't do is we can't suddenly bring assets in from accumulation into this account so we can create capital gains tax events. It had to be in this retirement phase before 9 November 2016. So watch that one. And lastly, I've got the wrong thing written in that slide. Lastly is if we've made that election to reset that cost base, it's a technical sale. So what that means is that 12-month period starts afresh. So we want to be careful if we make that election and then we sell that asset within 12 months for a further gain, we don't get that 12-month discount. So we're paying that 15% tax rate, not that 10% tax rate. So that's one to watch out for. What's going to become really important, I guess accountants and administrators are going to get hassled for what their 30 June accounts look like. For 2016, those accounts will be needed so we can plan moving forward to set ourselves up for this $1.6 million cap. And also, where do we need these valuation issues? It's on if we want to play concessional catch-up, because we've got that $500,000, member balance limit. Or if we want to make non-concessional contributions, we've got to look at, what are our member balances up to? And, for these accounts and starting these pensions, we've got to make sure that we get those valuations right. So looking at those ATO valuation guidelines, we're not doing historical valuations. If we've got investments in related unit trusts and stuff, it's got to be a real net asset basis, value. It can't be that historical kind of value. And this has been an area of focus for the ATO recently of out of pattern changes in, members' accounts and balances. And so, that's becoming quite important. And drafting those pension resolutions pretty tightly is going to become quite important too. So, look, I see that most of you still managed to hang on to this point. I know, there's a lot of material, and there's a lot to learn and get our heads around before, 30 June 2017. If we leave it till then, it's too late. I think we need these action plans, but if we're on top of it and we're proactive, look, these changes, for your superannuation advisors, they make you more valuable to your client, and more needed. So, as they say, change creates opportunity. So let's get on board. Look, I'm just going to briefly touch on, and I realise we're close on time, I'm going to briefly touch on limited recourse borrowing arrangements. This is what's happened lately. I won't go through, all the latest in limited recourse borrowing arrangements. I'll just focus on this cross-insurance. So the ATO is not allowing the trustee to allow members to take out cross-insurance on the other members. And this was a good strategy for, being able to pay down that debt under limited recourse borrowing arrangements and, fund, a lump sum for a member exit. So, that was good planning moving forward. Now, the ATO says that's not allowed. And also, if we haven't reached retirement phase, we've got to actually physically pay out the deceased spouse's members' benefits out of that super system. If we don't have a child pension, we can start. So that's looking like, there might be some forced sales under these limited recourse borrowing arrangements if there's an early or unplanned death of a member. Also, probably another warning that's got to be given in the statement of advices, when people are setting up these limited recourse borrowing arrangements for business premises, etc., that if one of those spouses dies, it might create some real problems moving forward now. And what I'll be focusing on in this next slide is what the latest developments are for these non-arm's length income arrangements for related party loans. This is what the ATO Compliance Focus is on a number of slides. I'll let you look at that in your own pleasure. Non-arm's length income for related party loans. This has been, watch this space. So the ATO's interpretation has been chopped and changed and continually developed in this area. What we're talking about here is when there's been a related party loan to a super fund to acquire an asset for less than market value. So it's, for example, if the interest rate was a zero interest rate. There's lots of rulings that say that's not, a zero interest rate is not a technical breach of any superannuation law. I've gone through that in past seminars, what they are. And it's not a regulatory breach. So it's not a breach of, it's not an ACR, so it's not an order contravention item. So on this, the ATO initially issued some private binding rulings. It said, well, look, in these items, non-arm's length income, that's where the statutory or ordinary income of a fund is greater than would be expected if the parties were dealing with each other at arm's length. Statutory and ordinary income is, usually your rent and those types of things in these borrowing arrangements. Because if you charge zero interest, that doesn't affect that statutory or ordinary income, it affects the taxable income. So because of that, there's no non-arm's length income problem because it doesn't affect the statutory or ordinary income. And so, that was the kind of go-ahead, but then the ATO changed their tune and issued some contrary private binding rulings, and they followed these up with these IDs. And what they said in those IDs was essentially, look, if it wasn't for this related party loan on less than market terms, on non-arm's length terms, well, the whole investment wouldn't have taken place, and so there wouldn't have been any income generated. So therefore, we're going to treat any of these arrangements, these schemes, where there was, the terms of the related party loan weren't at arm's length to create non-arm's length income. And then they put out this practice compliance guideline and their determination to say, oh, well, these are the terms that we consider if you don't go to a bank and, show what a bank would have been able to lend you in that situation. Here's our safe harbour guidelines. This is what the ATO considers to be safe. They've also said, if you get your house in order and make these loans consistent with an arm's length dealing by 31 January 2017, we're not going to look back to any prior years and bust you for that. So there's a good motivation to have a look at these non-arm's length related party loans and tidy them up in the soon future. But these IDs were withdrawn and they've been replaced with this taxation determination. And that's got the effect of a taxation ruling. So if you rely on it, and the commissioner takes a different approach, or there's a court takes a different approach, you won't get penalised, for that. And I'll talk you through. There's been some changes of how this works. What I'm submitting is we might even be able to use this taxation determination combined with these safe harbour guidelines, a bit more like a sword rather than a shield. So in this determination, they ask, is the loan on arm's length terms? If the answer is yes, well, there's no non-arm's length income because obviously they're dealing with each other at arm's length. If it's no, we have a bit of a further look, and we look, has the SMSF derived more statutory or ordinary income from the scheme than might be expected that to derive if they were acting at arm's length? Typically we go, oh, I don't know. If the answer is no, there's no NALI problem. If we're not sure, we then ask the question, well, what would the terms have been if the parties had been dealing with each other at arm's length? The ATO calls that the hypothetical borrowing arrangement. Now, that could be you had contemporary evidence from a bank or a finance broker of what the client in their specific circumstances would have been able to achieve, or otherwise we rely on that practical compliance guideline for those ATO benchmarks. So once we've set up that hypothetical borrowing arrangement, we then ask the objective test. Could or would the SMSF have entered into the hypothetical borrowing arrangement? So we're having a look. In that hypothetical borrowing arrangement, could we have paid the interest? Could we have come up with a 30% deposit, or whatever the deposit was required for those loan to value ratios? If the answer is no, well then the fund wouldn't have gone through with the structure and wouldn't have received any income. So the ATO is of the view that there's a possible non-arm's length income issue. Therefore, the consequence is that the income's taxed at the top marginal tax rate, not the discount rate. If the answer is yes, that we can prove that we would have been able to comply with the terms of that hypothetical borrowing arrangement, well, we're safe. So we don't have a non-arm's length income issue. So the consequence of that, I'll walk through, what the example is in the rulings. And so in this one, I'll call this, the naughty structure. So in this ruling, they said, well, we would apply the NALI provisions to this arrangement. And this is where the 100% of the funds were borrowed, $1 million. The fund did not have any cash. It didn't have $300,000 to kick in. The loan was for 25 years, 100% loan to value ratio, and interest only. Well, we'll say no repayments were required until that repayment date in 25 years' time. Whereas the hypothetical borrowing arrangement was, the fund kicked in $300,000, was at 30% deposit, and it was at that benchmark interest rate, and it was a 15-year principal and interest equal payments loan. So on those safe harbour guidelines, so those monthly payments. So what's important there is, in that case, the fund couldn't have afforded to meet those in principal and interest payments, and couldn't have afforded to, pay that deposit. In that instance, well, the non-arm's length income provides. But if we've got that right evidence, and we can comply with either those safe harbour guidelines or alternatively, evidence we've kept of what a bank would actually offer us, well, then your statutory and ordinary income hasn't been affected. So the ATO does not have that ability to determine that it's a non-arm's length income problem. So, perhaps aggressively, we could even combine this with, looking at transfer balance accounts, etc. I'm not saying you should, but, it could be something worth exploring. Here's the safe harbour guidelines, what they look like. So, this is if you want to comply with those guidelines, or if you want to rejig existing arrangements. We want to do that before 31 January if we want to get to that safe harbour place. I've done an animation on this one. I just published it this morning on YouTube. There's a link to this in the material. Otherwise, just Google Merthyr Law on our YouTube channel, and that will be there. I've also got on our YouTube channel I've done up a video of how for certain family trusts with default beneficiaries and certain unit trusts, how we can get business real property from the discretion from that trust into the super fund without paying any stamp duty. So, when people are focusing on, getting that $540,000 per member in before 30 June, or utilising those CGT cap while we've still got access to it, and the client was looking to transfer that business premises into super anyway, if you've got that ability that we can, save themselves $100,000 stamp duty, well, that's looking a lot more attractive for those clients. So, got a short animation on exactly how that works on that strategy. So, that's worth looking at. Similarly, with these limited recourse borrowing arrangements, I've got another one on YouTube, which is we can't typically redraw on equity under these limited recourse borrowing arrangements. Once you've paid off the loan, or if the property goes up in value, well, you can't tap into that equity and borrow again to purchase another property. In this video, I show how we can use a multi-fund strategy to effectively redraw on that equity, and we can do that without stamp duty. Where it's done to fund a relationship breakdown, we can do that without capital gains tax. But where it's just done to, for example, access that equity to buy another premises, or fund the exit of a business member or something like that, we'd have to manage what that capital gains tax consequence might be. But I've got a short animation explaining that one too, and I'll be doing more animations on different topics. So subscribe to that YouTube channel, and you'll get those updates as we put them on. So moving forward, these what strategies are here. I talked about we've got that potential zero interest related party loans. Now people might want to be looking at if you've got a client who's got well over the $1.6 million in that pension phase, having the financial advisor doing that financial advice of what that looks like. Is it worthwhile if they've got no investment assets outside of super, actually doing a lump sum outside of super so they can utilise that $22,000 tax-free threshold? Just being careful, interest rates might not always be at 2%. Really, having a good look of where it's appropriate to do that, refreshing that CGT cost-based election. I've talked about multi-fund strategies. We've talked about partial commutations if we're going to pay more than the minimum pension, and strategies of how you'll manage the clients doing the right thing there. Transferring that business real property into super while we've still got that 540 cap, maximising that 540 cap while we still can, or otherwise triggering that bring forward rule. Might be a good time to look at those recontribution strategies before 30 June again. As I said, reversionary pensions, might not be in vogue as much at the moment. Maybe we'd like to see if we can convert those to non-reversionary. Making sure we keep those two pensions for that 12-month window if we can, so we get two tax-free accounts rather than one. And in time, we'll be reviewing death benefit plans and having a look at binding nominations appropriate, are they not? Child pensions will become a lot more popular, playing with those. But then also not doing binding nominations unless they really need it might be a good strategy too. Converting transitions to retirement income streams to account-based pensions. So because those TRISs aren't tax-free anymore, if we've got someone who's over 60 and they got a TRIS, we really want them to convert that to an account-based pension. Now, they can do that by meeting a condition of release, and that is an arrangement in which they were gainfully employed has come to an end. So trying to manufacture that arrangement and make sure that the actual TRIS terms allow us to do that. So that becomes an account-based pension. And then, we've got that 0% tax rate. So we'll really be looking at that moving forward. So heap of stuff to cover today. I know, been going 100 miles an hour. But I hope I've given you some food for thought for, there's a lot to do, there's a lot to plan for in these next 6 months, and, really sharpen those pencils and think about, what strategy you're going to do for getting in touch with clients and members of super funds moving forward. You can find us, as I said, on YouTube, follow us on LinkedIn, for those kind of updates. And if you've got other people who might be interested in our different seminars, our live seminars, our newsletters, we've been doing a few webinars this year. Email us and join our mailing list. Otherwise, if you've got anything, if you'd like to, chew the fat or discuss anything, give me a call, and I'm always happy to have a bit of a chat. If you've got any further suggestions of, future seminars or assistance you'd like, or consultancy arrangements we can do, please give us a call. But everyone, thank you so much for listening to me for the last hour, and I look forward to working with everyone and implementing these changes and discovering all the intricacies of it moving forward. Thank you.